Oh, might as well go over to Zero Hedge for a minute, shouldn't we? Berkshire Leather highlights, that's Warren Buffett's company, 25 shocking $25 billion loss, and Buffett bashes deficit doomsayers, emerges as a closet Austrian. Austrian economics. In its latest, surprisingly short, at just 14 pages, annual letter, released at 8 a.m. on Saturday, Warren Buffett's Berkshire Hathaway shocked investors when it announced that quarter four net earnings plunged to a $25.4 billion loss, or $15,457 per share, from a $32.6 billion profit, or $19,790 per share, just a year prior, due to an unexpected write-down at Kraft Heinz in unrealized investment losses, even as revenues increased from $58.8 billion to $63.7 billion for the fourth quarter, while operating earnings increased from $3.33 billion to $5.72 billion due to increased earnings from Berkshire's railroads, energy business, and other segments. For the full year, Berkshire earned just $4 billion in GAAP profits, down 90% from $45 billion the previous year, prompting the Wall Street Journal to describe this as one of Buffett's worst years ever. Separately, in 2018, revenue increased 3% to $247.8 billion, while operating earnings hit a record $24.8 billion. Earnings. About operating costs. As a reminder, Berkshire's 2017 earnings soared in the fourth quarter of 2017 due to changes in U.S. law, the tax law, that lowered Berkshire's deferred tax obligations for stock investments that it currently holds. What was behind the company's sharp drop in 2018 earnings and the massive quarter four net loss? Think of it as the quarter-end marking to market of Buffett's massive equity holdings, coupled with the unexpected write-down of Kraft Heinz. And you know who's married to that family, right? John Kerry, the deep state. Remember the State Department? He was there, and one of the first people who Trump fired. That John Kerry. Skull and Bones John Kerry? Yes, that John Kerry. As Buffett explains in his letter, the components of that $4 billion full-year net earnings figure was $24.8 billion in operating earnings, a $3 billion non-cash loss from an impairment of intangible assets arising from Berkshire's equities interest in Kraft Heinz, which, as duly noted here before, plunged to an all-time low on Friday after a perfect storm of negative news. $2.8 billion in realized capital gains from the sale of investment securities, and most notably a $20.6 billion loss from a reduction in the amount of unrealized capital gains that existed in our investment holdings. Similarly, for the eye-popping $25 billion net loss in the fourth quarter, it was driven by $27.6 billion in unrealized losses from the investment portfolio. Why is this unrealized loss appearing now? And as Buffett explains, a new GAAP rule requires us to include that last item in earnings. As I emphasized in the 2017 annual report, neither Berkshire's vice chairman, Charlie Munger, nor I believe that rule to be sensible. Rather, both of us have consistently thought that at Berkshire, this mark-to-market change would produce what I described as wild and capricious swings in our bottom line. You mean you got to report something you used to not have to report? Okay, got it. A note on Kraft Heinz. The company contributed a $2.7 billion loss to Berkshire in 2018, compared to adding $2.9 billion to its earnings in 2017. Kraft Heinz on Thursday wrote down the value of some of its biggest brands, disclosed an investigation by federal securities regulators, and slashed its dividend, sending its stock plummeting. Lashing out at the new GAAP requirement, Buffett contrasts the wild fluctuations in the bottom line with the steady moves in operating profits. Buffett then warns that the swings in its quarterly GAAP earnings will inevitably continue, largely due to because of the company's huge equity portfolio, valued at nearly $173 billion at the end of 2018, which will often experience one-day price fluctuations of $2 billion or more dollars, all of which the new rule says must be dropped immediately to our bottom line, he said. Indeed, in the fourth quarter, a period of high volatility in stock prices where we experienced several days with a profit or loss of more than $4 billion. So how about that for daily trading swings? Buffett's advice on how to reconcile these numbers? Simple. Just ignore the massive month-to-month losses and focus on operating earnings, paying little attention to gains or losses of any variety. By saying that in no way diminishes the importance of our investments to Berkshire. Over time, Charlie and I expect them to deliver substantial gains, albeit with highly irregular timing. Cheer up, Charlie. Run away, far away. Cheer up, Charlie. And while Buffett has traditionally encouraged shareholders to pay attention to Berkshire's book value over its market value, he said in the letter that market value is now the more relevant metric. In other words, after railing against non-GAAP, Buffett would be delighted if he could present his own GAAP net income as a non-GAAP number. Irony. Here is the breakdown, which I don't have to really break it down. Commenting on the portfolio, Buffett said that Charlie and I do not view the $172.8 billion detailed above as a collection of ticker symbols, a financial dalliance to be terminated because of downgrades by the street, expected Federal Reserve actions, possible political developments, forecast by economists, or whatever else might be the subject du jour. What we see in our holdings, rather, is an assembly of companies that we partly own and that, on a weighted basis, are earning about 20% on the net tangible equity capital required to run their business. These companies also earn their profits, without employing excessive levels of debt. And the loss on one of those companies happened again. Why? What else? There's a bit more to this letter. It's quite a bit more. Holy crap. But I think at this point I'm done doing a video. Take care.